A lot of people think billion-dollar business empires start with money. They imagine some rich founder sitting in a glass office moving millions around like chess pieces. But most large holding companies did not begin with giant piles of capital. They began with structure, with leverage, with ownership, with one small asset that produced cash and someone disciplined enough not to spend it. That is the part most people miss. The game is not about earning more income forever. The game is about building a machine that acquires other machines, and every level of a holding company changes how that machine operates. Because the strategy that gets you from zero to your first company is completely different from the strategy that gets you from 10 million to 100 million. And the mindset that builds a $100 million portfolio is usually the opposite of what creates a billion-dollar empire. So today, let's walk through every level of a holding company, from $0 all the way to a billion-dollar empire. And the crazy part is, the first level looks almost nothing like the last. At $0, most people think they need investors. They think they need connections. They think they need startup funding or venture capital or some magical opportunity to appear out of nowhere. But the first level of a holding company is usually much simpler than that. It is one person with a useful skill: sales, marketing, operations, recruiting, systems, logistics, automation, something that improves a business owner's life immediately. Because at the beginning, you are not buying companies with cash. You are buying them with capability. There are thousands of small business owners right now who spent 20 or 30 years building something profitable but outdated. They understand their industry. They understand customers. But they do not understand modern systems, digital marketing, AI tools, automation, hiring pipelines, or scaling operations. That gap creates opportunity. So the first acquisition often is not a traditional acquisition at all. It starts with partnership, sweat equity, revenue sharing, seller financing. Maybe you improve operations in exchange for ownership. Maybe you manage growth while the founder slowly exits the business over time. That is how people acquire control before they acquire wealth. And control matters more than people realize. Because ownership percentage alone means almost nothing without governance. Someone can own 80% of a chaotic business and still have no real leverage because the systems are broken, the cash flows are inconsistent, and the structure is messy. Meanwhile, another person can own 30% of a stable operation with proper agreements, voting control, and strong cash flow, and effectively control the entire direction of the business. Governance beats percentage, always. Now, somewhere between $0 and $100,000, the biggest thing you are really building is not revenue, it is credibility. This is where most people destroy themselves because they operate informally. Personal expenses mixed with company money, no contracts, no clean bookkeeping, verbal promises, random equity splits with friends, no operating agreement, no real systems. That feels harmless early on because the business is small. But small messes compound into massive problems later. Every serious holding company starts with clean structure, separate entities, separate accounts, proper accounting, clear ownership, written agreements, clean cap tables, real documentation. Because eventually banks, investors, partners, and buyers will look at the structure before they look at the revenue. A messy business tells sophisticated people one thing immediately: this operator is not disciplined, and discipline is everything in capital allocation. Now let's move into the next level, the $1 to $10 million stage. This is where the holding company stops being an idea and starts becoming a system. Because one business can still survive on hustle, 2 or 3 businesses cannot. At this level, operators start learning something uncomfortable. The second acquisition is harder than the first emotionally. The first one feels exciting. The second one exposes weaknesses. Suddenly, communication breaks. Reporting becomes inconsistent. Cash starts moving unpredictably. One company needs attention while another has problems. Hiring standards vary. Financials look different across entities. This is where most business owners realize they are not actually building a holding company. They are building chaos with multiple logos. The companies that survive this level create what is called a platform layer: shared accounting, shared legal, shared HR, shared reporting systems, shared dashboards, shared hiring processes. The holding company itself becomes infrastructure, and this matters because infrastructure creates compounding efficiency. Every new acquisition becomes easier than the previous one. Without infrastructure, every acquisition becomes harder. That difference decides whether the portfolio scales or collapses. This is also where deal sourcing changes. At the beginning, opportunities come from luck or personal relationships. But around this level, reputation starts creating deal flow. Accountants refer retiring owners. Attorneys mention your name during business transitions. Brokers bring opportunities because you are known as someone who actually closes deals. That reputation becomes an asset by itself. And something else changes here too. You stop chasing revenue and start chasing cash flow quality. This is critical. A holding company does not care about vanity metrics. It cares about durable, predictable cash generation. Because predictable cash flow can support debt, and debt, when used carefully, becomes fuel for acquisitions. Now, obviously, reckless leverage destroys companies all the time, but disciplined leverage is one of the fastest ways holding companies scale. That is why so many acquisitions use seller financing, earnouts, bank loans, asset-backed lending, or SBA structures. The goal is simple: acquire assets where the business itself helps pay for the acquisition over time. That is how empires scale faster than personal savings ever could. Now, once the portfolio crosses somewhere around $10 to $50 million in enterprise value, the founder's role changes completely. At this level, your job is no longer operating businesses. Your job is capital allocation, and most people are terrible at this transition because operators are trained to solve problems emotionally. Capital allocators solve problems mathematically. That sounds cold, but it matters enormously. At this stage, every dollar inside the portfolio competes for survival. Which company deserves more investment? Which company should be sold? Which division should expand? Which management team should change? Which market should be exited completely? These decisions become the actual business, not the operations themselves. And this is where weaker holding companies plateau, because founders become emotionally attached to businesses that no longer deserve capital. A company that was a fantastic acquisition at $5 million may become a distraction at $50 million. But people struggle to let go because of history. Professional capital allocators do not think that way. The capital goes where returns are strongest. That is the entire game. This is also where governance becomes serious. No more informal meetings. No more figuring things out later. Now you need real boards, outside advisors, structured reporting, quarterly reviews, financial controls, compliance systems, and audit quality accounting. Not because regulators are forcing you, because complexity is. At this size, small mistakes become expensive incredibly fast. One weak subsidiary can infect the entire structure if risk is not properly contained. And this is why holding companies obsess over entity separation. Separate books, separate liabilities, separate accounts, documented intercompany transactions. The membrane between companies matters. If one operating company gets sued, the others should survive. That is not paranoia. That is architecture. Now, once a holding company starts pushing toward $100 million and beyond, institutional capital enters the picture. And institutional money changes everything. Banks become stricter. Private equity firms want reporting standards. Family offices demand governance. Lenders require covenants. Investors want visibility into risk exposure. At this level, charisma stops working. Systems replace personality. And honestly, this is where many founders quietly fail. Because the skills that built the company are no longer enough to manage the company. A great entrepreneur is not automatically a great institutional operator. Different level, different rules. Now the holding company begins behaving more like an investment institution than a group of businesses. Capital budgets are planned annually. Subsidiaries compete internally for resources. Performance gets reviewed against hard metrics. Cash gets pulled upward into the holdco and redistributed strategically. Every allocation decision has opportunity cost, and eventually, the holding company starts thinking globally instead of operationally. Industry exposure, geographic concentration, debt maturity schedules, insurance structures, tax efficiency, succession planning, liquidity events. At this level, the founder is not managing businesses anymore. They are managing risk, capital, and time. And then comes the billion-dollar level. This is where holding companies become ecosystems. The founder is no longer the center of the organization. The systems are. Professional CEOs run subsidiaries. Independent boards oversee governance. Entire departments exist purely for acquisitions, compliance, treasury management, and capital allocation. At this level, the empire compounds because the machine itself attracts opportunity. Sellers want stability. Banks want relationships. Investors want exposure. Operators want incentives. The holding company develops gravitational pull. And ironically, by the time the portfolio reaches this size, the founder often spends less time making operational decisions than ever before. Because billion-dollar holding companies are not built through constant intervention, they are built through systems that continue functioning without intervention. That is the final evolution. The founder goes from operator to acquirer to allocator to architect. That progression is the real journey. And almost nobody understands this early enough. Most people spend their entire lives trying to maximize income while the people building large holding companies focus on maximizing ownership, governance, and capital flow. Completely different game. So wherever you are right now, ask yourself one question. What level are you actually operating at? Because every level has a ceiling. And the habits that helped you reach your current level may be the exact habits preventing you from reaching the next one. The person running one business needs structure. The person running 5 businesses needs systems. The person running 50 businesses needs governance. And the person building a billion-dollar empire needs institutional discipline. Different levels, different tools, different mindset. That is how holding companies scale from 0 to $1 billion.